Good afternoon, everyone. This is Henry Gambell with simpleroptions.com, and in today's free video I wanted to spend some time with you discussing what I see here in Best Buy's earnings. Now, there's several ways you could look at this chart, and when I begin approaching something for earnings, there are several things to take into account. One of them that I will get started with is the weekly charts to make note of. Am I seeing anything off of the weekly charts that suggests I could have a bigger than expected move? Now in this case, we do have a weekly squeeze that is forming, so I've got to keep that in the back of my mind. Now it doesn't guarantee that the signal will fire off of the move, but it's just something you need to be aware of. Then when I come down into the daily chart, where you'll get a little bit better feel for your ranges, now what I start to take into account is, well, several things really, but one of the first that I'll start with, because anytime you look at this chart, the first thing that I think most people might tell you is that you're seeing a break in this trend line. Well, yes, that's true, but I don't know that that is the best way to decide what or how a market is trending. What I prefer to do is come back down and look at symmetry inside a move, which is another way of saying look at the declines that have preceded the current decline that we're going through and compare them to each other. When you look at this, you can start to see how this move is technically still holding symmetry support, and it's one of the things that leaves me a little bit more neutral on the chart as opposed to just being straight up bearish, because that's how I've been playing most of our retailers here lately, and it's also just the bias that I have for Best Buy. So whenever I look at a chart and I say, okay, I've got a bias or a bearish take on it, it's still holding technical support, what type of strategy do you end up applying to this? One of my favorite ways of thinking about it is begin with what would be a short straddle and then work your way backwards. So a short straddle on something like this would be here at 32.5. And now you could modify it a bit because, of course, doing the 32.5 here implies that you're selling that one about 25 cents in the money, but that's okay because I have a bearish take on it anyway. So let's look at selling the 32.5 straddle. And then if you'll use the control key that's in the bottom left-hand side of your keyboard, this will work on Macs as well, because I have no intention in getting to this with unlimited risk, inevitably, as sure as I do. You know, they'll have some type of a blowout or whatever it is. I just don't know that that's an easy position to carry into earnings. So, to help define that risk, what I will do is scroll down the options chain and see what point do I start getting to diminishing returns. Because there's no point in buying the 27 as protection when you can do the 28. You know, you're tacking on a full additional $1 of risk while only saving yourself 3 cents on that transaction. Now that's an extreme example. If I wanted to take that and make it a bit more realistic, essentially where it lands me is right here about this 30. That's where I'm still getting some decent protection on it. I'm not having to go too far out, and by holding that control key and then coming in to buy the 30 and doing the exact same thing on the opposing side by buying the 35, I've now constructed an iron butterfly where if I have $2.50 wide, that means that I'm going to have 80 cents of risk in this, the potential of making $1.70. And that is the way that I'll be looking to play these guys into tomorrow. So I hope that helps, gives you some insight into how we will look at these various trades, how to define your risk while still collecting some premium, and we'll see how that plays out tomorrow. Y'all have a great night, and I will see you at the next free video.